Hello everyone, welcome to Demand Supply Trading Practical Session number 26 for the year 2025. Myself Sujit Kakkar, and today is Sunday 6th of July 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. So in case you've still not joined this channel and you wish to join it, there are a few different ways it can be done. The first one is you can scan the QR code which is on your screen, and by scanning that QR code, you will be able to join the Telegram channel. The second way is the direct link, which is available in the description. You can also click on that and you can be part of this Telegram channel. And the last one is that once you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. So once you are on our website, you can just scroll down on any of the pages, and in the footer section, you'll be able to find this option which says join Telegram channel with the join now button, and you can click on this button and you can be part of this Telegram channel. All right, so that takes care of how you can be part of the Telegram channel and be updated with content related to demand supply trading methodology. Now, talking about today's session is practical application of demand supply methodology. So our demand supply course, which used to be a paid course, is now available as a 100% free course. How can you access that course? We'll talk about it as we move ahead in the session. But once you go through the course, you basically learn the methodology theoretically, right? What is demand supply, how it has to be applied. But unless and until we see some practical examples, at times we don't get a very good understanding of how to implement it. And that is what we do in these practical sessions. So every weekend, I do a practical session where we look into the application side of the methodology. And for this, I'll take some examples from the markets, and to those examples, we'll be applying the complete methodology so that you can understand how to plan trades very mechanically and rule based. Now, the best part about these sessions is that when I'm doing the analysis, we are not analyzing something which has already happened and I'm just justifying it. That is not how it goes. The beauty of demand supply methodology is that we can pre-plan the areas where we would like to be buyers and sellers. And because we are pre-planning, we can see both before as well as the after, right? So it's not that something which has already happened, I'm justifying it by applying some indicators, by applying some oscillators, which is a piece of cake and can be done with, I'll say, any random indicator, any random oscillator. The real fun is when you're doing the analysis in advance, and that is what we do. We analyze in advance, and just because I'm doing the analysis in advance doesn't mean that I share the analysis with you and then we forget about it. Whatever analysis I share with you, whenever they get triggered in the future, we also review them, and that helps you see both the before as well as the after, and that also helps you build confidence in the methodology, because unless and until you have that confidence, probably you will not be very inclined towards learning that particular style of trading. So again, practical sessions, they are as transparent as they can be because we do the analysis in advance, and eventually whenever those trades they get triggered, we also review them. All right. Now, to be comfortable in these sessions, there are some prerequisites, and if you will complete these prerequisites, these sessions will be much more easier on you. So let's talk about what these prerequisites are. The very first one is the Trading Essentials course. So the reason it says optional is because if you already have a very good trading background, you might want to skip it. It can be done, but otherwise, I'll highly recommend, irrespective what your trading background is, do start with the Trading Essentials course. But yes, if you are a fresher, you have no option. You'll have to go through the Trading Essentials course first. But yes, for someone who already has a very good trading background, a very good trading experience, they can skip the Trading Essentials. Now, how do you get access to Trading Essentials? Very easy. Once you visit our website, under services, you'll be able to find the second option which says courses. Click on courses. And here you can see all our courses are listed. The very first one is Trading Essentials. Click on that. And you will see that you can start the course in English and Hindi. So whatever language you're comfortable with, you can click on it. It will take you to our playlist, which covers the complete course in a very systematic way. You have your lesson 1, lesson 2, lesson 3 lined up for you. So once you go through all the lessons, that basically covers the Trading Essentials course. Now, once you're done with the Trading Essentials course, the next step is to complete your demand supply trading course. Now, demand supply course will cover the complete methodology theoretically, where you will be learning what is demand supply, how to identify zones and all those things, how to qualify zones. Now, how do we get access to the demand supply trading course? Again, very simple. Once you visit our website, under services, you have the option which says courses. Click on it, and you can see the next option. Just give me a second, please. Right, so you can see the second option is your demand supply trading. So you simply click on it, and you can see this course is also available in two languages, English as well as in Hindi. So whatever language you're comfortable with, you can click on that. You will get access to the playlist, which covers the complete demand supply trading methodology. Now, what we also do is that these practical sessions that I take, we also keep an archive of them, so that if you want to watch some practical sessions, you can always access them from here. So once you click on practical sessions, you have again both the options, English sessions, Hindi sessions, so you can watch the previous sessions. And the reason for that is the more number of practical examples you will see, the better you'll start having understanding of the methodology. So you have access to the to the previous sessions recordings. You also have access to the live sessions, which I do almost every other weekend, and that basically covers the complete demand supply course from theory to practicals. All right, so that's your demand supply trading course. Now the next thing is, during the practical sessions you will see that I use two documents. One is the rule book and the other one is the flow chart. Now, how can you access these documents? Again, very simple. Under services, you have the option for downloads. Click on that, and here you can see you have the rule book and the flow charts. You can click on downloads, and you can download these documents. So this is the rule book, and this is the flow chart, and how to use them, you will experience it during these practical sessions. All right, so let's get started with our today's session. Now, before we get started with today's analysis, like I already said, that whatever examples I share with you, when they get triggered, we start with the review of them. And today we have one example which got triggered for us. So we'll start with the review of it. And after reviewing it, we'll start with our today's analysis. So just give me a second. Perfect. So this is your session number 24, which was on 15th of June, right? So we did the analysis for this on 15th of June. On 15th of June, the chart would be something like this. So if you go back, you watch the recording of 15th of June, this is how the chart was. And when we did the analysis for this one, it had a score of 10 out of 10 for quality, which made it as a high quality trade setup, and 4 out of 8 for probability, which also made it as a high probability setup. And high quality, high probability setups can be done as a type 1 trade. So this was qualified as a type 1 trade for us. Then what happened, you can see eventually on the 20th of June, prices came into our zone. Now, when the prices came into our zone, we'll be checking how is my reward to risk ratio. Now, for your targets, it is not mandatory that you require quality areas. For our targets, we use all structures of demand and supply. You can see when the price started coming back into our zone, we had a formation of a supply area, which is this drop-based drop. So if I do a candle replay, you'll be able to see it right here. So you can see when the prices, they started coming back into the zone, we had this drop-based drop, which is now telling us that our reward to risk ratio is about 1:1. But again, if you think about it, this zone has already been tested. And as a rule, we do not use tested zones for our targets. So even if we had a formation of a zone, the zone was tested before the price came into our area of demand. And plus, if you also look at the analysis, when we did the analysis, this was a trade setup which was at the best location. And at best locations, if you look at the rules for the target in the rule book, you will see that our rule is that we always use the opposing fresh zone on the lower time frame. In this case, the opposing zone was already tested, therefore it was not our target. Now, even if this would have been a fresh zone, you can see at best locations, we can also use the intermediate time frame. So in a way, target was not a very big challenge because we were planning our trade at the best location. But anyhow, this was already tested, so not our target. This zone is also tested, not our target. Our target is this fresh area, which is showing us about, you can see if we talk about our target, this is my 1:1, this is my 2:1, this line is my 3:1, this line is my 4:1. So my 5:1 would be probably somewhere around here, 5:1, and this target is approximately 6:1. So if you talk about your reward to risk ratio, we had about a 6:1 reward to risk ratio on this trade setup, which definitely made it as a valid trade for us. And on this particular candle, as a type 1 trader, you would have got your opportunity to participate. After that, what happened? You can see prices, they started moving up from the zone. And at 1:1, you can see now we have cleared our 1:1. So at 1:1, we make our trade as a break-even trade. That is what our rule is for our risk management. So your stop loss, which was initially here at 1:1, now can be revised to your entry price, which means the worst case scenario is it is a free trade for you if the prices they come back, and if they continue towards the target, we'll keep trailing onto it. And eventually what happened, you can see prices, they violated this area of supply. So now the fact is this supply has also been violated, but we don't have a formation of a newly formed demand area. If there was a newly formed demand area, we could have trailed it. So as of now, we don't have the opportunity to trail it as well. And then you can see by the end of the 2 weeks, why by the end of the 2 weeks? Because last week we did not do a practical session. Last week we launched our latest indicator, which was version 6. So the session was on that particular indicator. But if you look at the setup as of now, we have got the opportunity to make it as a break-even trade, which we have already done. And we are almost at 2:1. So we have already hit a 2:1. Now, let's say your trade plan is at 2:1. You always exit. You would have closed your position at 2:1. If your trade plan is okay at 2:1, I want to book my partial profits. Let's say I want to book my 50% profits. That can also be done. So again, different traders, different uh, I'll say personality style, different rules, right? But what we will do is we will follow it based on the trade plan that I've shared with you. And in that trade plan, what we do is at 1:1, we only make it as a break-even trade. So currently this will be trailed at break-even. Eventually, if we get the opportunity to further trail it, we'll start trailing onto it. With a target which the chart is showing as of now is approximately 6:1, right? So for a 6:1, we'll keep trailing onto it. And this will remain as an open trade for us because we haven't got an exit on this as of now. So that's the only trade which got triggered during the week. In fact, the last 2 weeks. And now that we have done the review of it, we can start with our today's example. So just give me a second. Let me bring up the today's example and we'll start with that. Perfect. Great. So this is our today's example. We'll start with the analysis for this now. Perfect. Now, whenever we talk about trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have still not watched that video, the link is available in the description. Make sure you watch that video, understand the process, go through that process. Maybe you'll have to go through that process twice, thrice, but there is no bypassing it. The sooner you start implementing it, the sooner you will see that you'll start becoming a more of a rule-based trader and less of a trader who's planning his or her trades based on emotions. So very important lesson. So do ensure you watch that video, understand the process, and start implementing it. Now, because we need to be mechanical and rule-based, we need to create something which is called as a trade plan. Now, the challenge here is when you're learning something new, it is not easy to create a trade plan from day one. So what I've done is I have made your life easy. I have created a trade plan for you, which is a combination of two documents. Like I already talked about these two documents. One is your flow chart. The other one is the rule book. Even though if you talk about this rule book, it's a very conservative approach. With time, with experience, you can definitely make modifications to it to better suit your personality style. But at least you do have a starting point using which you can start planning your trades in a very mechanical and rule-based fashion. So what is my step number one whenever we start planning our trade? Step one is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and the duration of the trade is from the time we enter the trade to the time we exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So do not assume, but by exit, I only mean profit exit. Exit can be in profit, exit can be in loss, exit can also be break even, any kind of exit. So now the question is, why are we starting with the trade purpose as our very first step? And the reason we are doing that is because when we do our analysis, the charts that we use, they are time-based charts and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis, right? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frames. We go with a very logical approach. And that logical approach is that the longer I want the duration of the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But if you talk about the markets we are analyzing, like I take examples from NSE, which is not a 24-hour markets. So whenever you're trading markets which are not 24 hours, I'm pretty sure you people would have experienced that whenever the market opens, some symbols they'll gap up and some symbols they'll gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand holding a position overnight in a market, which is not a 24-hour markets, has that risk of gap, and we don't want to take that unnecessary gap risk initially when we are still in our learning phase. We don't have that, I'll say, confidence in our analysis. So that is why, as a risk management rule, my recommendation to all of you is that your hourlies and dailies should be strictly done as intraday trades when you're trading markets which are not 24-hour markets, because we don't want to take unnecessary overnight gap risk. Now, for weekly monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that for weekly monthlies, we cannot have gap against us. It can still happen, but the probability definitely reduces because the bigger the time frame, the higher the weightage, but it can still happen. But once you start having more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight trades, that can definitely be done. But initially, we'll be avoiding that. So again, step one, I need to define my trade purpose so that I can choose my time frames based on what kind of trades I want to take. And let's assume that in this case, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Just give me a second, please. All right, next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate time frame used for trend analysis. Lower time frame is daily. That is where we get our SETS from. SETS stands for stop loss, entry target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart. So you can see as soon as I opted my purpose of trade, I got the clarity to what time frames I'll be using, plus what is the purpose of each and every time frame. Now, very important, remember this table, which is on page number 31, is specifically for the NSE market because this market is only open for 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, maybe some international market, cryptocurrencies, then you can look into this table, which is on page number 32. All right, so let's get back. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if I again take the example of NSE, on NSE, I have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies to identify my trading opportunities. So how do I get a smaller list? Because we do require a smaller list to do our homework so that we can identify where are the opportunities which match with my trade plan. So this is done by using certain computer programs which are called as scanners or screeners. So if you do a Google search, you'll be able to find a number of scanner screeners, which are free scanner screeners, and they can be based on fundamental analysis. They can be based on technical analysis. So what these scanner screeners, they basically do is that we input certain conditions into them, and whatever symbols match with those conditions, it shortlists them and tells us, okay, these are the symbols which are matching with your conditions. But the problem here, I'll say, was that all these scanner screeners which were available were, like I already said, were based on either fundamental analysis or conventional technical analysis. There were no scanner screeners based on demand supply trading methodology. So that is where we also created 2 custom built tools. One is called as the demand supply alerts. The other one is called as the demand supply screener. And like I was talking about just last Sunday, we updated them to the latest version, which is version 6. Which can now even be used by people who have a free TradingView account, right? Previously, if you had a free TradingView account, these were not very useful to you. But now, even if you have a free account, these tools will be very, very useful to you. Now, if you want to understand how these tools they work, what you can do is you can click on them and that will take you to our product pages where the walkthrough videos are available. You can watch those videos and understand how these tools they basically work. In fact, I'll just quickly show you how you can also do it from our website. So once you visit our website, under services, you have the option which says TradingView indicators. And here you can see you have your alerts, you have your screeners, you can click on subscribe, and on those pages, you will be able to find the walkthrough videos to understand them better. I'll also quickly just guide you what they basically do. So what alerts basically do is that you input your list of symbols, okay, that these are the symbols which I would like to monitor. Now, what will happen is that during the live market, as soon as you have a formation of a demand area or a supply area, it will immediately notify you. So what alerts is basically doing is that during the live market, whatever list you have selected, as soon as there is a formation of a demand zone or supply zone, it gets shortlisted for you that on this symbol, you have a formation of a demand area or a supply area. So just as an example, if you are, let's say, monitoring only the Nifty 50 stocks, so humanly not possible that you are watching all those 50 stocks simultaneously. But if you give this list of 50 stocks to that alerts, now what alerts will do is, as and when you have formation of demand and supply area, let's assume that you are trading on the 15 minutes time frame. So as soon as you have a formation of a demand zone or a supply zone on 15 minutes time frame on any of these 50 symbols, it will immediately shortlist for you and tell you, okay, this is where the zone has formed. So now you don't have to manually monitor those 50 symbols. You just keep getting the latest updated list where these zones are getting formed, and once you know that this is where the zone has formed, you can go to that particular symbol and check whether that zone matches with your trade plan or not, and if it matches, it might be an opportunity for you. So that is what alerts are. And what screener basically does is that even in screener, you can give your list of symbols. Let's assume you have given your list of symbols, and then you say, okay, I only want the symbols where the current candle is, let's say, within 2% to a demand area or a supply area, and whatever symbols are closer to demand supply areas and within that proximity range, they will get shortlisted for you. So that's the difference between the two, that alerts, they shortlist based on zones which are getting formed during the live market. Screener shortlists based on the proximity of the current candle to a demand area or a supply area. And that demand supply zone might have formed today, might have formed a month ago, might have formed 6 months ago, might have formed maybe 10 years ago. But as soon as you're within that proximity range, it gets shortlisted for you. So again, this is for shortlisting symbols where you are almost about to enter a demand or a supply zone, or maybe you're already inside a demand or a supply zone. And this is for shortlisting symbols where you have formation of demand supply zones during the live market. All right. So yes, again, if you want to shortlist based on demand supply, you do have these two tools which can help you shortlist. So whatever process you're using, be that the conventional technical analysis, fundamental analysis, be that these tools, the end result is that from a very big list, we get a small list. Now, very important, once you get that small list, you cannot trade them blindly, because remember, scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list, which you will have to analyze manually and check out of this what matches with my trade plan. And whatever matches with your trade plan might be an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So let's assume I got a list, and in that list, the very first one was ABC. So what am I supposed to do now? I need to go to the symbol ABC, and I need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1. That as a monthly income trader, my lower time frame will be daily. So we'll go to the daily chart, and on the daily chart, we need to identify zone. And by zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. Now, the best part here is that we also have a demand supply zone indicator, which was also recently updated to the latest version, which is version 6. And during the launch, I showed you that this latest version is almost 20 times faster than our previous version. And we also offer a 100% free trial of this indicator, because we understand that manually identifying these zones is a very big challenge. And like, our motto says that trading simplified. So we want to make trading as simplified for you guys as possible, and that is why we have all these tools which can assist you in doing your demand supply analysis and make it very, very simplified. So now, how do you get access to the 100% free 7-day trial of the demand supply zone indicator? So if you've still not taken a trial of it, I'll just quickly help you how you can do that. So first thing is, you'll have to visit our website. In fact, I think the direct link should also be in the description. Now, once you're on our website, under services, go to TradingView indicators, and you can see the very first one is zone indicator. Click on that. And here you can see you'll have the option for 7 days free trial. Click on 7 days free trial, and you just have to fill this very short form. Probably it will take you less than maybe 30 seconds. So first thing is, how did you hear about us? Choose the appropriate option, provide your full name, provide your email address, provide your TradingView username. Now, very, very important, do ensure you're providing the correct TradingView username, because if you're providing an incorrect TradingView username, it will not get activated for you. It will get activated for the person to whom that TradingView username belongs. And again, just to be very sure that you're providing your correct TradingView username, after inputting your TradingView username, you can click on verify. It will take you to your take you to that profile, and you can just double check if that profile belongs to you. Now, in case you don't have a TradingView account, you can click here. You can create a new TradingView account. And once you have created your TradingView account, then you can input your TradingView username here. If you already have a TradingView account and you're not sure what your TradingView username is, you can click here and you can visit your TradingView profile page, and that is where you'll be able to identify your TradingView username, and then you simply submit this form. So very short form. Like I said, probably will take you less than 30 seconds. And once you have filled up this form, within 24 hours, the indicator will get activated for you. And once it gets activated, you'll receive a notification on TradingView that now you have access to it. And then you can try it for free for 7 days. So since now everyone has that opportunity that you can try the indicator for free for 7 days, whatever analysis we'll do it purely based on the indicator, which also shows the advantage of the indicator, plus how beautifully it can help you in planning your trades when it comes to demand supply trading methodology. So let's assume that this was the symbol which was shortlisted for us. And you can see as soon as you apply the indicator, it is identifying all your demand areas and supply areas. And I can see from the current market price, the nearest demand area is right here, which is a rally-based rally. So let's draw this rally-based rally. So my step number 3, which was to identify the zone, the indicator has automatically done it for me. It is identifying this rally-based rally structure for me. So my step number 3 is complete. Is the zone available? The answer is yes, we do have a zone available. Now, once you have identified a zone, does not mean you blindly trade it, because uh, we can have a number of demand areas. We can have a number of supply areas on the chart, but the question always is that, is this a zone which matches with my trade plan, or is this a zone which is qualified for me to use it as a tradable opportunity? For that, we have to qualify, and for qualification, we have a two-step process. In step 1, we'll qualify based on certain conditions, and in step 2, we'll qualify based on the booster scoring. So the first thing we'll check is this zone a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zones divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, it might be a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? Now, if you look at the indicator settings here, you can see you have the option where you can choose what is your higher time frame. Like I'm doing monthly income analysis, so my higher time frame is the monthly chart, my intermediate is the weekly, and my refining is the 60. And then you can also choose what kind of zones you want on these particular time frames, again based on your personal preferences. So these can be customized based on your preferences. So now what will happen is, as soon as I shift to these time frames, whatever analysis needs to be done, the indicator does it automatically for us. We don't have to make those changes manually. So let's go to our intermediate first, and you can see on the intermediate, we do have a zone, which is this rally-based rally structure. So yes, we do have a rally-based rally structure on the intermediate. Let's change the color. So the one in pink is my intermediate time frame zone. The one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate? The answer is yes. So since we can see that my lower time frame zone is inside of my intermediate time frame zone, we do have a coinciding level. But now the question is, do we have a case of level on top of level? So if you look into it, you can see inside of my intermediate time frame, which is this intermediate time frame zone, I only have one zone. And as of now, the indicator is only identifying quality areas for me. But in case of level on top of level, it is not mandatory that all zones might be quality zones. So I can double check by enabling all demand supply structures. And you can see if I enable all demand supply structures, we still have only one zone inside of it. So we have a coinciding level, but we don't have a case of level on top of level. So yes, going with the very first condition, which is level on top of level, it is not applicable. Now this zone is not because of a gap, therefore gap rules will also not apply. Pivot non-authenticity not applicable, because pivot non-authenticity we only apply to a drop-based rally or a rally-based drop. Unstable equilibrium also not applicable. So talking about all these conditions, none of the conditions were applicable. And if these conditions are not getting applied, they cannot disqualify the zone, right? Only if they get applied, then there are two possibilities, either qualified or disqualified. But if it is not getting applied, by default, is the zone qualified for us? The answer is yes. So now that we know we have a qualified zone, the next step is to understand its booster scoring. So let's apply the boosters. The very first one is freshness. We can see the zone is fresh just based on the color of the zone as well. It is getting marked in green, and green basically implies it's a fresh zone for us. If it would be a tested zone, like here, you can see the color is marked in cyan. So this is green, which makes it as a fresh zone, gets a score of 3. Strength, we have an explosive move. That is the reason the indicator is marking it, gets a score of 2. Time at the zone, we only have one candle in the basing, which is again a score of 2. Reward to risk ratio, we'll take it as an assumption. Now, talking about location, if I go to the monthly, even though you can see I have my automatic settings enabled, you might say, okay, then why the indicator is not plotting the curve for us? And the reason for that is that to draw the curve, we need both demand as well as the supply area. So we do have demand, but we don't have supply. So that is the reason the indicator cannot do the curve analysis unless and until we have both of them. So in this case, there are two options available. Option number one, you can say that for my curve analysis, I need demand, which we already have, but I also need supply, which is missing. And since I am a very conservative trader, I don't have supply zone on the higher time frame. I will skip this symbol. I'll move on to the next symbol. I'll analyze the next symbol. That's the most conservative approach. The second one can be, okay, I do have demand, I don't have supply, but can I still do my analysis on this by using some logic? The answer is yes. And that logic is, if you think about it, if the prices, they move down from here. So what I'm doing is that from the current candle, I'm trying to see where is the most recent high. So this is the most recent high from where prices started moving down. So logically, if you think about it, if the prices, they move down from here, there can be only one reason, and that reason has to be supply. The only problem is that that supply is not visible on the monthly time frame, which is my higher time frame. But if I start going to some smaller time frames, I'm pretty sure that somewhere around here, I might be able to see a structure of supply. So just as a random example, I'm just marking this wick, right? And now let's start going through different time frames, and I'll say I want to see all demand supply structures. So if I go to the weekly, you can see on the weekly, we don't have any supply structure. If I go to daily, you can see closer to that, we do have an area of supply. If I go to maybe a 4 hours chart, you can see we do have some supplies here. So again, if you think about it, if the prices, they move down, there has to be supply, right? There cannot be any other reason for prices to move down. It's just that the supply was not available on the higher time frame, but you can see now on the smaller time frames, we can definitely identify those structures of supply. So with this logic, what we can do is, if I don't have a supply area to draw my curve, I can use this most recent pivot high as a reference point, and from this reference point, I can do my curve analysis, right? So what I can do is I can start from here, and I can draw my curve all the way to this, and let me change this to curve. So now I've still done my curve analysis, but the only difference is, instead of having 5 divisions, we have our very low of the curve, we have our low of the curve, we have our middle of the curve, we have high of the curve, but very high of the curve is missing because we did not have a higher time frame supply zone, right? So that's the only difference. But we have still done our curve analysis. And where is my lower time frame zone located? My lower time frame zone is located in very low of the curve location. So now we have made a logical modification, and based on that, we are still able to do our analysis. So yes, talking about curve location, we are at the best location, gets a score of 2. Now at best location, trends, they become irrelevant. Doesn't matter whether we are in an uptrend, downtrend, or sideways. All kind of trends can be traded with a score of 1. But if you look at the chart as of now, the chart is telling us we are in a sideways trend. We have one supply violation, we have one demand violation. You can see this was the supply, drop-based drop. And if I further go back, this was the demand, which is again a drop-based rally. So we have one supply, one demand violation, which makes it as a sideways trend for us. All right. But like I said, best location trends are irrelevant to us. Irrespective, whatever the trend would have been, this would still be a score of 1. Move from the zone, we need at least a 4:1 move. Let's see, did we have a 4:1 move? So 1:1, 2:1, 3:1. So as of now, we only have a 3:1 move, for which I'll give it a score of 0. But yes, you never know. Prices might move up and then might start coming back into our zone. It was not a case of level on top of level. We already verified it, but definitely it was a coinciding level. And the last one is trap. Can it work like a trap? The answer is again, I think yes, because if we start wherever the zone is and I just start pushing it just a little higher, you can see somewhere around here, if I bring in a little bit more history, probably somewhere around here, you can see this area has beautifully acted like resistance, acted like support, acted like support, again acting like resistance, again acting like support, and we have our zone sitting right below it. So what will happen is, people who believe in support resistance, they will be looking at this area as an area of support resistance, and because of support, they would be interested in buying somewhere around here, and their stop losses will be placed below this, and those stop losses will be sell orders. And people who believe in breakout, if the prices they go down, they'll say, okay, we have a breakout, and because of that breakout, again, people will start selling. So we know by the time we enter the zone, we'll have quite a few people who will start selling because of their stop losses, because of the breakouts. And these people are making two novice mistake. Mistake number one, selling after a decline in price, which means selling at a cheaper price. Mistake number two, selling in an area where the chart has proven to us that back in history, demand exceeded supply. So they are making these two novice mistakes once the prices they enter this area of demand for us, which can make it work like a trap. Therefore, we'll give it a score of 1 for it. So if you look at the overall scoring, just give me a second again. All right, so if you look at the overall scoring, we have a score of 10 out of 10 for quality, definitely with the assumption of reward to risk ratio, and 5 out of 8 for probability, which makes it as a high quality, high probability trade setup, and high quality, high probability setups can be done as type 1 trades. So after doing our analysis, we got to know this is going to be a type 1 trade for us. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So that is why we also need to be ready for the worst case scenario, for which we'll do our proper position size calculation, so that if the trade does not go in our favor, we do not lose more than what our risk management rule allows me to lose. Now, whenever the prices are back, we'll re-verify, because markets are not static, markets are dynamic, conditions are changing almost every other second. So before entering a trade, we need to re-verify, does it still qualify based on my trade plan? If the answer is yes, we place our order based on the entry type, in this case a type 1 trade. And once your entry has been executed, the last step is your trade management, which you saw today when we were reviewing our trade from session number 24 at 1:1. We talked about we make it as a break-even trade, which we have already done. And after that, if we get the opportunity to trail onto it, we'll start trailing onto it. And we still have a live example with us, which is session number 24, which we will be managing unless and until we get an exit on that. So this is how we plan trades in a very mechanical and rule based way. Now, before we move ahead, a few important things. If these sessions are helping you plan your trades better, then do like the video. And if you're not subscribed to my channel, do subscribe to it, so that whenever I do these live sessions, you get notified and you can be a part of these sessions. Plus, if you have some friends or family members who are into trading, or if you are part of some trading group, you can share the link to my course content. You can share the link to these live sessions. You can share the link to the trial of the demand and supply zone indicator, because I know a lot of traders are struggling when it comes to trading. So the more we share with people, the more we are helping the community. Just give me a second again. Right. So like I said, the more we share, the more we are helping the trading community. And you never know, this might help someone be a better trader and avoid maybe some big losses, which otherwise, if they did not have the understanding of how to plan the trades properly or manage the trades properly, they might have incurred. All right, now at the end of the session, I definitely take questions, queries which you people have. So whatever questions, queries you have, you can start putting it into the chat box. But before I answer them, I would also like to add that one feedback which I get from you people, I was getting from you people, was that what if I don't want to ask my questions publicly, or on the YouTube chat, we cannot share our charts for analysis. What if I want to share my charts for analysis? I want to get them reviewed. So now we do have an option which is called as one-to-one session. So if you feel that you need a one-to-one session with me, you can always schedule it from our website. So once you visit our website, on the top right corner, you'll get the option for this. There are two kind of sessions available. One is a voice call, where if you feel that only on a telephonic conversation you can ask your questions, queries, and that will suffice, then you can go for the voice call. And if you feel that you want to share your screen, you want to share your analysis, then you also have the option for online meeting, right? So these are the two options available. But otherwise, you can always share your questions, queries during the session, the YouTube live session, where I try to answer all the questions that I get in the chat box. So let's see what do we have today in the chat box, and let me follow those. Let me answer those questions, queries. Okay, so the first one is it really starts? See, the session starts at 11. So if you would have joined a little before, the session would have not started. And again, it is 11 as per the Indian Standard Time. I'm eagerly waiting 8 a.m. to join. Okay, so again, the session was always scheduled at 11. I don't know why did you join at 8. But again, remember, we always share when these sessions are happening on our Telegram channel. So if you want to know well in advance, you can be a part of our Telegram channel. I shared at the starting of the session how you can be a part of it. And that is where we always notify you when these sessions are happening in advance so that you don't miss on them. So, but the move from the zone is not 2:1. Is it still a valid trade? So, do you mean the move from the zone for the one that we reviewed? So again, see, even if you talk about, let's say if this was not a 2:1 move or it was not a 4:1 move, we have already taken that into consideration while we were doing the booster scoring. So if we have already taken that into consideration and still it is getting qualified as a type 1 trade, it is definitely a type 1 trade because we are already going through our trade plan. Right, so you're getting my point. So even if the move is not there, if other conditions were not helping me, right, maybe it would have got converted into a type 2 or a type 3 trade. Or let's assume I am a trader who says that my rule is unless and until, now let's take today's example. If I say my rule is unless and until I get a 4:1 move, I will not be planning a trade, then this is not a trade for me. But if somebody says as long as my trade plan or my booster scoring allows me to take that trade, I'm happy taking that trade. So why not? And can you see in that case, we have already taken into consideration the move has not happened, right? But even after taking that into consideration, we still have a score of 10, we still have a score of 5, which makes it as a valid trade for us. So again, it all boils down to what your particular trade plan is. My trade plan is as long as the booster scoring allows me to trade it, it's a valid trade for me. My booster scoring is allowing me to trade it, it's a valid trade for me because it is matching with my trade plan. The booster scoring is telling me, yes, you can go ahead and do it as a type 1 trade. So again, is it mandatory to have that move? The answer is only if that is part of your trade plan, that I only want to take trades where a 4:1 move has already happened, or maybe a 3:2 move has already happened, whatever it might be. Right. So if you have that as part of your trade plan, then maybe yes, it is not a valid trade for you. But if that is not part of your trade plan, all you're saying is, okay, this is what I'm looking at. And if even if you don't have the move, I have already taken that into consideration. It is still qualified for me. I will go ahead and take that trade. Acceptable, right? Nothing wrong with that. So again, all boils down to how you are planning that trade, and based on that, you can always make your decisions. All right, so that answers your query. So can you help us with a process plan? I mean, what should we do daily? Start with open positions management and then move to finding opportunities and review journal, etc. What to know? Okay, so if I talk about myself, see, I'll tell you what my daily process is. My daily process is that once the markets are closed, first I will look at all my open positions and see if I got the opportunity to make any modifications to them. So what do I mean by modifications? Do I have the opportunity to trail onto it? Do I have the opportunity to make some of these trades as break-even trades? So if those opportunities are there, at least I'm managing my trades. That is what I start with. Next, what I do is, because now I need to identify more opportunities for me the next day, I specifically use the screener. So I'm not saying just because I'm using screener, you people also have to do exactly the same thing. It's your choice, whether you want to use the screener, whether you want to use the alerts. So whatever is more in sync with your style of trading, use that tool. Identify your opportunities for the very next day. Place your alerts, because if you're placing your alerts, you don't have to monitor all the charts all the time. So that is what I do. I always place my alerts closer to the zone so that whenever the prices are approaching these zones, I get notified. Once I get those notifications, I simply double check, do they still qualify based on my trade plan? If yes, I place my orders, and I'll say all my orders are bracket orders. So my entry, my stop loss, my target, all orders, they go together. And after that, again, if the trade gets executed, the last step is trade management, which we already talked about. That is what I start with. I look for what trades I need to modify or manage if they have been executed. And I guess that's my routine, right? It's not very complicated, very simple. Manage your trades, which you're already into. Find new trades, take those trades, again manage those trades, and just keep repeating the cycle. All right, so that basically covers the questions, queries I had for today's session. So thank you everyone for joining in. I will be seeing you now the next weekend, where again we will be getting into the practical application of demand supply trading methodology. Until then, trade safe, enjoy your Sunday. Take care. Bye bye.